Inline CPI sends futures flying with 30 minutes to go until the official start of trading. I'm Katie Greifeld.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
And coming up, no surprises here. Consumer prices rise in line with most forecasts. 90 more days. President Trump extends a trade truce with China into early November, but Beijing's new guidance on Nvidia chips may stir up tension once again, Danny.
And we're so relieved that CPI came in line that even with that story, Katie, Nvidia is heading higher this morning. Some stocks to watch. China is telling companies, as you said, to avoid Nvidia's H20 chips, especially for government or national security related work after the U.S. lifted its ban. Meanwhile, President Trump's meeting with Intel CEO Lip-Bu Tan appears to have gone well. Tan scoring more tops with members of Trump's cabinet. Katie, those shares taken off, up 3 1/3%.
Yeah, what an interesting couple of days for Intel. We'll continue to follow that story, but it's still earnings season, and Circle reported its first earnings since it went public. Now, it lost money in the second quarter, mainly due to IPO-related charges, but reported a 53% jump in revenue. That's being rewarded with an 11% gain pre-market. Danny, this stock up more than 400% since it went public.
100%. Just a slight rally there. Katie, let's get back to one of our top stories and the data this morning, where underlying U.S. inflation accelerated in July to the strongest pace since the start of the year. Let's break down that data with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what did we get?
Well, we got a few surprises underneath the hood, but no surprise in, except for core year over year in the headline numbers, because as you mentioned, we got a 0.3% gain and not anything that's going to concern anybody on the headline. A lot of that was gasoline, the 0.2 gain there. Gasoline was down 2.2%. Core up 0.3%, but it was a strong 0.3. Services prices were up by 0.4, so it pushes the headline core to 3.1%. The Fed is going to be watching that certainly into September, and we'll see what we get when we get the August numbers for this. Goods and services both rising. Service prices kind of making people a little bit nervous. They were up, as I mentioned, 0.4%, and they're up by about 0.3, a little more than 0.3 for the year-over-year number. Goods prices rising again as well. You can see the little white lines there on the right side of the graph showing that goods prices are now rising. But the real question is what moved, and did tariffs have an effect? And they sort of did. You take a look at what was in the numbers. Airline fares were up 4% in total, and the gasoline prices I mentioned down 2.2%. But tomatoes, President put a tariff on Mexican tomatoes, so tomatoes up 3.3%. Appliances last month were up big because of the tariffs on steel, but this time they're down 0.2%. We buy a lot of furniture from Asia. Furniture and other household furnishings up 0.7%. So we are seeing some tariff impacts. Katie, I know you're worried about coffee. 2.3% rise. Tariffs on Brazil.
There you go. There you have it. I am curious, Mike, when you parse the different sectors trying to find the impact of tariffs, how much is that pull forward effect sort of distorting things here? Because we saw that across industries at the start of this year.
It's starting to fade some because companies have now used up their inventories. So we're just on the cusp of what's going to happen. We're going to have to watch this for a few more months because, as I say, the inventories have been worn down now, and companies will have to pay whatever they're going to have to pay for replacements. And at the same time, we're just getting the tariffs imposed in many areas, and there are more to come. So the question is going to be how fast do they come, the pharmaceuticals, the semiconductors, and everything else, and how fast did that show up in the data?
All right, a lot to look forward to. Then that is Bloomberg's Mike McKee breaking down that economic inflation data that we got at 8:30 a.m. Clearly, the market likes it. Futures really extending their rally after we saw those numbers hit. Let's talk about trade, though, because President Trump extended a pause of higher tariffs on Chinese goods for another 90 days, taking us into early November. Here to explain is Bloomberg's global trade editor, Brendan Murray. So 90 days pause from the U.S. China said in a similar statement that it would extend its own suspension as well. What's going to happen between now and early November?
Well, the two sides are going to continue talking and trying to maintain the stability that they've managed to achieve so far. We're going to see most likely a regular series of discussions. The way Scott Bessent has led the U.S. delegation in talks with his Chinese counterparts, most recently in Stockholm. So they've gotten to a place where they believe that things have stabilized and they can start making progress toward ultimately what President Trump wants is a big trade deal and a summit with President Xi. And we're many months from that, but where we've now got some sort of process set up to accomplish what the U.S. hopes to accomplish. Of course, China is playing a much stronger hand this time around than they played in Trump's first term, and they have control over critical minerals. And they most recently have indicated that they don't really need these U.S. Semiconductors that the Trump administration has signed off on the exports of. So it's a changed dynamic, but one that at least investors for the time being can breathe a bit of sigh of relief to say for the next 3 months at least, it looks like things are going to be kind of in some sort of ceasefire when it comes to tariffs.
To that point, Brendan, of China having a strong hand, prior trade deals that the U.S. reached with other nations, it was the U.S. that came in with a strong hand, and other countries basically bowing down to what America had asked of them. What does that mean about this timeline for China and how long it will actually take to not just kick the can, but get a deal done if China does have that strong hand?
Well, I think it changes the dynamic, really. The President Trump tweeted just 36 hours ago or so about wouldn't it be great if China bought more soybeans? And, these are kind of like 2019 things, and China is now has got a much more sophisticated and complicated negotiating tactic with President Trump, rather than just we'll buy some more soybeans and other agricultural goods to appease the White House. So these other countries, Japan, South Korea, and the European Union still don't have their executive orders, so they don't really have in writing what they've agreed to in a handshake so far. Those will still have to come, and as Mike McKee suggested, these tariffs are still kind of rolling in, and they only really kicked in at a higher rate 5 days ago. So the dynamics and how they play out into the economy are really only getting started.
Brendan, thank you very much for your coverage this morning. That is Bloomberg's Brendan Murray. Now let's stay with China. Beijing is urging local companies to avoid using Nvidia's H20 chips. The guidance is not an outright ban, rather a discouragement, particularly for government-related purposes. However, the information out with their own report this morning saying that China has demanded companies to halt Nvidia chip orders over security concerns. You're seeing Nvidia raise some of its gains pre-market on that report. Joining us for more is Bloomberg Tech co-host Ed Ludlow. Ed, we don't have this information match at the moment, but from what we do understand with how China is approaching Nvidia and other high processors, just how big of a hit are they taking, even if the U.S. is allowing them to sell chips into China?
Well, there's an issue of chronology because, as Bloomberg reported, notices were sent by Chinese authorities in recent weeks, which would predate the news of 24 hours ago when the president confirmed he had reached a deal for revenue sharing 15% with Nvidia for the H20 going to China. This is quite normal behavior across Chinese authorities and the internet watchdogs in particular to say to government entities and state-backed enterprises, do not use foreign technology if there is a security concern. The issue that the street's going to be looking at this morning is probably a little bit of rethink and remodeling on how the most bullish forecasts look of Nvidia starting to book revenue again from China. A lot of the analyst community look at this and then the 90-day extension and see it as a negotiating tactic from China, either because they want access to the higher performance chips that Nvidia is not allowed to send to China based on current US rules, or the opposite. They're trying to protect their domestic champions that are increasingly gaining ground in this space. Huawei has chips that are better than the H20. But I would note that there has been a move lower since that information report. The initial pre-market spike was very much in line with CPI. So there's some noise there in the market.
So you can see Nvidia shares pretty much unchanged now on the morning. Traders deciding what to do with these reports. Ed, I do want to move on and talk a little bit about Intel here. I think if you look at the 5-day chart of Intel, it's really amazing. You can see when exactly President Trump took aim at Bhutan, and you can see, of course, the reaction now that they seem to be back in good graces after Bhutan visited the White House yesterday. It really speaks to how much Intel needs to curry favor with this administration, how much they're relying basically on having a good relationship with President Trump.
Yeah, last Thursday on Truth Social, President Trump called for Bhutan to resign because of historic ties to China. Those ties, by the way, are well documented in the technology industry. It's been known about for a long time. And Intel's board of directors knew about them as well when they appointed him CEO. The thing is that on paper, what Intel wants to achieve as an American company that's trying to grow its manufacturing footprint in this country, it's highly analogous with the AI strategy of the administration. That is what they are focused on. Things that are tangible, can be invested in and built quickly. And, you know, the reporting is that he will continue to meet with other cabinet members. Intel has just not been there in the race. You know, they have not been put at that level that Nvidia or even AMD have from how the president communicates to champion those companies in leading America's AI efforts.
Yeah, absolutely. That has been the narrative dogging Intel for well over a year now. Ed, I know you'll have much more on Bloomberg Tech. That is at 11 a.m. That is Bloomberg Tech co-host Ed Ludlow. Meanwhile, let's get back to these broader equity markets in reaction to that CPI data that we got at 8:30 this morning, coming in as expected, Danny. And you can see how that is being greeted by the bulls right now. The S&P 500 higher by about 0.4%. Similar story when you take a look at the NASDAQ 100, and that two-year yield falling as people recalibrate their Fed bets.
It was definitely a bond market that was prepared for an uglier and a hotter number. So in line is good enough, perhaps going forward. The worry is that services inflation didn't come in as much as expected, and that's supposed to offset any goods inflation coming from tariffs. So one, maybe flying the ointment that might cap some of the rally from here.
Absolutely. But at least for right now, folks seem pretty happy. Better than feared, as you said.
Definitely. Well, coming up, we're going to talk earnings. Circle extending gains, even though it reported a loss in its first earnings since the IPO. We're going to have details for you next on Bloomberg Open Interest. Let's get you some high interest stories. A look at what's making headlines around the world. Shares of Hanes brand, they are jumping in the pre-market, up 37.5%. A report that Gildan is closing in on a $5 billion deal to buy the underwear maker. The FT reporting that the deal may be agreed to by the end of the week. Negotiations, though, they are not yet final. Sinclair shares, those are also jumping this morning, up just under 19.5%. It launched a strategic review of its broadcast business. It announced that it's considering also a separation of its ventures unit. On holding, that's also rallying this morning, up nearly 17%. It raised its full-year outlook. The Roger Federer-backed company reported better than expected earnings, had strong demand, and sees revenue growing more than 30% on a constant currency basis this financial year. Katie, I should admit my bias. I have two pairs of on holding, so yeah, you're welcome on.
They're hot. They're trendy. I'm more of a hookah gal, but we can get into that.
A house divided.
There you go. We'll get into that in the commercial break. Let's talk a little bit about Circle shares. They're surging despite posting a one-time quarterly loss. Traders optimistic after revenue jumped more than 50% in its first earnings report since it went public. Remember, it IPO'd at $31 a share on June 4th. That certainly feels like a long time ago. Bloomberg's Bailey Lipschutz joins us now. So, okay, they had that one-time loss. It was revenue rising 53% that has traders psyched this morning.
That and the fact that there's still that scarcity value. This is still one of the better performing new companies, up about 6x from where it priced at its IPO. Katie, and beating expectations really kind of on the top and bottom line. The big question, though, is the fundamentals of the business, and we were talking about that. This is a company that benefits from shorter dated treasuries. That's where they're holding their cash, and is basically, if we do see 3 rate cuts, as investors are increasingly betting on, that could dent kind of their outlook, but the big question is, what does that mean for crypto?
I think it's fascinating, and this is really where TradFi and whatever this is really intersect. The fact that it does hold a ton of those short-term bills, as you say. So if that's the case, you get these earnings on the same day that you get CPI that people are looking to as really cementing in the idea that we're going to get a September rate cut, really not affecting the stock at all, up 14%.
No, not at all. And the one thing that we did talk to a few analysts about before earnings was this debate. If we do see the Fed cut 3 times, what does that mean for a company like Circle? And if you want to take the bullish view on the entire crypto space, well, maybe there's more leverage. Maybe there's more demand for crypto assets. Maybe there's more demand for DeFi assets, and that could actually benefit Circle. But again, that is kind of bulls talking their book to an extent.
And should say the Circle CEO is going to be on BTech at 11:30, so one to watch out for. Bailey, another hot IPO that we're going to get the earnings for is CoreWeave. How high is the bar after we heard from all the hyperscalers and the amount of spending they're doing on AI?
I think it's quite high. This is a stock that's up about 250%. We are seeing it under a bit of pressure this morning, so this is going to be a closely watched report. The big question, especially with some of these newer companies in these hot spaces like AI and computing, is what does management say on the earnings call? How do they address some of the tougher questions? Because this is a stock that's hotly debated, not only by the buy side, but by the sell side. 16 holds, 5 buys, and 3 sells. Average price target implies a 16% sell-off. So there's a lot of debate around if this company deserves its current multiple and where it's trading at. And one thing to also keep an eye on, as analysts have called out, lockup is expiring later this week. So that's going to open up about 80% of shares available for trading. That's going to be key.
Yeah, that's interesting that we're getting this report on a Tuesday afternoon. As you mentioned, the lockup expires on Thursday. How does that usually go? What does it usually look like when we see that lockup ending?
It can get choppy. The big thing with a number of these companies, this is a hedge fund hotel, if you will, as some of the skeptics put when they were going public. The big thing is a lot of the long-term investors, as bankers and investors will say, need to play fair. You don't want to see a rush to the exits. That only hurts each other. So the big thing is going to be, do we see some slow selling? What does that actually look like? We will likely see some filings on Friday if we are seeing investors going towards the exit. So it can increase volatility. But again, you have a hot stock in a hot area with a lockup expiring.
Maybe
Fireworks.
take some profit?
Exactly.
I was going to say, they're sitting on some pretty paper profits, so maybe they want to make that real. Bailey, thank you so much for joining us. That is Bailey Lipschultz. Coming up on the show, Nuveen's Chief Investment Officer, Saira Malik, on the CPI print and potential frothiness in markets. Stay with us for that conversation. This is Bloomberg Open Interest.
The bulls will say there is further room to go in terms of positioning. However, there is also some substance to embolden the bear narrative, and in particular the fact that the average FMS cash level remains at a low 3.9%, which historically has been a strong signal to say that global risk assets are toppy, as now is a good time to retreat or hedge your position.
That was Bank of America's Elias Gallo following their survey showing that a record number of investors see stocks as overvalued. Nuveen's CIO and head of equities and fixed income, Saira Malik, joins us now to discuss. And Saira, I would love to hear you weigh in on this debate because, yes, okay, U.S. stocks look expensive, but then you compare that to what we're seeing in the economy, what we're seeing in underlying corporate America right now, and there's a real debate to be had.
What you think of U.S. stocks depends on 2 factors, and that's technology and also earnings growth. So let's start with the latter. Earnings growth is very strong for the second quarter. We came into this quarter expecting almost 5% earnings growth from consensus. We're going to end the quarter at about over 10% earnings growth year over year. That's positive for the U.S. economy. And secondarily, it's been led by technology stocks and that continued investment in artificial intelligence. And if you're bullish on tech and their earnings growth, tech earnings has accounted for almost 2/3 of earnings in the recent history. We are bullish on technology and the continued spending in artificial intelligence. So I think that is supportive for a stock market, which I agree is trading at a worrying premium.
Saira, there has long been this expectation that tech dominance and especially advancements in AI would at some point mean a broadening out of the rally as other companies adopt tech. When and if ever does that play out?
We've certainly not seen the broadening of the rally to small caps or even cyclicals at this point. And I agree, you would expect to see that start to play out given the strength of the economy. But as I said, earnings have really been driven by tech stocks. So we've not seen the earnings growth to support these companies. And with the economy showing some signs of slowing, with employment missing numbers last month, that again bodes well for technology stocks, which have their own structural growth drivers. So that is a challenge where you're seeing this continued imbalance where technology is leading the way and just about everything else is getting left behind.
Well, I think it's the 5th time that I've mentioned this stat from Goldman, but I think it really encapsulates what we're seeing and what you're saying, that you think about the second quarter, you had the Magnificent Seven grow their earnings by 26%. That number was just 4% for the rest of the S&P 500. Saira, what is it going to take to finally see earnings broaden out in a consistent way? Is it rate cuts? Is it something else?
Aggressive rate cuts. Now, given the CPI number today, odds are on the table for a rate cut in September, but whether we get 25 or 50 basis points, the question after that will be, where do we go from here? So are we going to get aggressive rate cuts that stimulate this economy even further from a manufacturing and cyclical point of view? I think that's unclear. Now, the good news for cyclicals, though, is manufacturing is coming back to the United States. One positive call we've had outside of tech is infrastructure. Not only is that a play on a resumption of more manufacturing in the U.S., but it's also a derivative tech play with AI data centers and the need for building those in the U.S. So you can find areas outside of tech that sort of are on both sides, a play on a stronger economy and also a play on artificial intelligence, and that's infrastructure.
Saira, literally just a minute here, but for those who've said that this market is too concentrated, that it's starting to look like a bubble, what would you say to that?
Well, I've been in the industry for 30 years, and technology has made this market look concentrated for almost a decade now. So I would be careful of just trading in and out of the markets based on valuation, because that can be very painful. I was a small cap growth portfolio manager in the late 90s, so I lived through that period where markets in tech looked expensive. What they have going this time that they didn't have in the late 90s is that earnings growth. In the late 90s, we had a lot of companies out there that were public that were unprofitable. If you look at the tech leaders today, that's Microsoft, Nvidia, Broadcom. These companies have very strong sales and earnings growth. And so I think that is what is different this time around.
It's an important point. We're talking about big, mature companies. Saira, we're just getting started. You're sticking with us through the opening bell, which is up next. Don't go anywhere. This is Open Interest, and you can see it's setting up to be a green open. This is Bloomberg. All right, we are moments away from the official start of the cash trade on this Tuesday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. We have green on the screen behind me. An interesting setup, too, after we got those inflation figures at 8:30 a.m. for the month of July, coming in line with estimates, maybe a hair higher when it comes to annualized core, but no one seems to be worried about that at this moment. The S&P 500 rising in the pre-market. It's actually the small caps that are outperforming today as you see those treasury yields come down, especially at the front end. Traders saying that September looks like a lot for a Fed rate cut. You can see the bells ringing behind me as we officially welcome in the start of trade today. And there are some things to keep an eye on under the surface. One of them is China telling companies to avoid Nvidia's H20 chips, especially for government or national security related work. That's after the U.S. lifted its ban. Meanwhile, you have President Trump's meeting with Intel CEO Lip-Bu Tan appearing to have gone well, with Tan scoring talks with more members of Trump's cabinet. And you can see that those shares are rising right now. Nvidia maybe a little bit less.
I was going to say, I've got to look for you, Katie, on those. Maybe the reason Nvidia is rising less, indeed it was in the red in the pre-market, was the fact that we had this report from the information that China was outright asking companies to stop importing them. You mentioned Intel up 2%. Katie, let's also get a look at Circle this morning, because it reported its first earnings since going public. It lost money in the second quarter. That was mainly due to IPO-related charges, but it reported a 53% jump in revenue. And Katie, those shares are up nearly, just under, I should say, 14%.
And we're back now with Nuveen's CIO and head of equities and fixed income, Saira Malik. So a really interesting setup here. Saira, I want to go back to that trade discussion, because you do have China and the U.S. extending that 90-day pause. At the same time, you do have those issues percolating under the surface when it comes to Nvidia's chips in particular. We think about the discussions of trade talks across the world, it feels like, but how important specifically is that U.S.-China relationship and making sure that it stays open?
U.S.-China relationship is crucial, I think, in terms of trade talks. And that, I think, has always been one of the main areas of focus for this administration. Part of this Nvidia is negotiations that will be ongoing. I think a bit of relief for the markets that we get a 90-day delay here. But overall, what we see in terms of tariffs is up to about 15% tariffs across the board outside of the U.S. And if you calculate those numbers in terms of how they affect GDP and inflation, they should be a drag of on GDP of about 1.5% or so, and a bump to inflation perhaps of 1% over time. Of course, we are not seeing that show up dramatically in the inflation numbers yet. That would get you quite close to a recession. So it'll be interesting to see how this plays out over time with the impact of tariffs.
To your point, Saira, they're not showing up in the inflation numbers yet. It's worth just taking stock of where we are in the market because some of the gains in treasuries have petered out. Indeed, only the 2-year yield is gaining, but now less than 2 basis points. Saira, part of the data we got this morning was services inflation that continued to look hotter than expected. It was supposed to be services coming down to offset some of the core goods inflation rather. Does that give you pause if other elements, non-tariff related elements, look more stubborn?
Short-term good news for the markets is investors expected CPI to come in today hotter than expected. So that's the positive and why markets are looking to open up. Now, the shift, exactly as you pointed out, from goods to services is the issue. In the past, we saw some pickup in goods inflation last month with toys stronger than expected, sporting goods being strong. Services had not seen a pickup in inflation. Now, today, of course, what we see is that inflation creeping over and spilling over from goods into services. And that is an issue for the consumer in terms of, is the consumer now starting to make tougher choices because of the impact of tariffs? We'll see how that plays out from here. Of course, as you noted earlier on holdings, it's not spilling over to athletic shoes at this point because that number was very strong from them. But I think consumers are making tougher choices when it comes to experiences, how much they're going to pay for airfares and hotel rates going forward.
Absolutely. I mean, that seems to be the anecdotal evidence that's out there. Not seeing it in the numbers yet, but that could change in the months to come. Let's talk a little bit more explicitly about what's going on in the bond market, because you see a reaction to these numbers. The 2-year yield down about 2 basis points or so. You take a look at what the 10-year yield is doing. It's been percolating in a really interesting range over the past few weeks. It had felt like we were glued to 4.5%. That seems to have reset a little bit lower. Now we're hanging out between 420 and 430 on your benchmark. Where do you think we go over the course of 2025?
10-year yields likely remain about range bound. We've come a long way from where we were when we saw the spikes during Liberation Day 1.0. But bond markets have been calmer about inflation and the outlook for the U.S. economy going forward. We see an incremental slowing for the economy. We started to see that with payrolls last month, which came in at 73,000. And the Fed rate cut for September, whether we get 0, 25, or 50, we're in the camp of 25 with upside to maybe a 50 basis point rate cut. That would depend on how do non-farm payrolls look for August. Do they come in again sub 100,000, and are they disappointing? How does the next CPI number look? The Fed has stated that they would look at inflation related to tariffs as a one-time bump. So I think that's what the bond market is counting on. Now, looking within fixed income, there's an area that we like, which is preferred securities. And you're talking about what do we like outside of technology? Preferred securities and fixed income are backed by the strong fundamentals of U.S. banks, which are in good shape. So areas like preferred securities and also municipal bonds, where fundamentals are also strong, are attractive areas within that segment.
Saira, even though there's attractiveness in bonds, to your point, we saw a whole host of weak auctions across the curve last week. How much of that is due just to lower yields, less attractive following the payrolls report, versus some really serious challenges for the bond market around things like Fed independence and a growing deficit?
Those are issues that have been bubbling up. The growing deficit has been something that investors have been thinking about for quite a while. High interest rates, of course, even more problematic for the deficit. So I see that as a structural medium-term to longer-term issue that the U.S. needs to think about and how to deal with it. In terms of looking at the Fed independence, there's been some volatility around that for equities as well as for bonds. I think the Fed will stay independent, and we'll soon find out what's going on with the next Fed chair nomination. So those are issues for the bond market. But I think generally U.S. safe haven status remains intact now that we've gotten our arms around what's going on with tariffs, and the economy is slowly decelerating, but not at a rate where a recession is imminent. Those are all positives for the bond market, and why we've seen Treasury yields move to a more stable base versus what we saw in April.
Well, to your point on figuring out who the next Fed chair is, it just feels like that potential list continues to get longer. We heard from Jim Bullard on CNBC this morning saying that I'll accept Fed chair job if we accept Fed independence. So a lot of question marks there. But Saira, before we let you go, I do want to ask, what is your preferred haven in this market? We're talking about the bond market. It feels like treasuries in particular have been a bit of an unreliable hedge. I don't know if gold near record highs is trading as that hedge or whether you see somewhere else as your preferred form of protection here.
I like areas which have their own structural growth drivers that can remain resilient in any kind of environment, including a recession. So I talked about infrastructure earlier. Infrastructure not only has the positive of manufacturing coming back home, but the components of infrastructure tend to be utilities and waste management. We still turn on our lights and take out our garbage during a recession. So it tends to be more resilient, and it has that growth upside from artificial intelligence and data center growth. Second area we like is an income providing area within equities, dividend growers. These companies tend to increase their dividend over time, so they have very strong cash flows and balance sheets. Again, more resilient on the downside, but also able historically to capture much of the upside of markets.
All right, Saira, great to spend some time with you this morning. That is Saira Malik of Nuveen. Meanwhile, let's get a check on the stock market right now. You're just about 8 minutes into the Tuesday trade, and you can see we have some pretty good breadth on this rally. The S&P 500 higher by about 0.6%. You have more than 400 names in the green right now, and you can see it's Meta, Microsoft leading the way higher. Apple and Alphabet, Amazon also putting up a fight as well. That is leading to some pretty sizable gains when it comes to your benchmark following CPI. But on the downside, this is what you need to keep an eye on. Cardinal Health is up there at the top, reporting pretty poor earnings, or at least not being received well by the market. Nvidia, you can see trading places here. It's switching around, but Nvidia erasing its gains. We did have the information report that China told companies to halt their orders of Nvidia's chips. That seems to be affecting Nvidia's sentiment. But let's take a look at the sector level, because as of right now, you have a perfect score. 11 out of 11 in the green. Communication services and financials up top. Your relative underperformers today, energy, consumer staples, and utilities. But Danny, overall, this is a very risk-on market.
It is, despite the fact that bond yields have given up some of their gains, or rather we're looking at a long end that's now pushing higher and only a front end that's coming lower. It is the continued optimism of the equity market versus pessimism of the bond market. Speaking of some of that pessimism, you mentioned it, Katie. Coming up, we're going to discuss China urging companies to avoid Nvidia's H20 processors. How much does that complicate Trump's AI chip deal? We're going to have more on that story coming up next on Bloomberg Open Interest.
Welcome back to Open Interest. A quick check on this rally extending right now. The S&P 500 higher by about 0.7%. There's a lot going on with tech, with the chips, which we'll talk about in just a moment. You can see the Nasdaq 100 also rising by about 0.7%. It's the small caps that are stealing the show right now. The Russell 2000 outperforming. It does help that you have yields declining a bit in the wake of CPI, but as Danny pointed out, those gains are starting to dissipate a little bit in the bond market, so we'll see if small caps can hold on to this win. But it's time now for our top calls. Some of the analysts' action in focus this morning, and first up, Baird upgrading Starbucks to outperform, expecting that new leadership will effectively drive its turnaround strategy. Starbucks shares up about 2.5%. Next up, you have Piper Sandler upgrading Chipotle to overweight, seeing limited downside after falling 25% over the past month alone. And finally, you have Argus downgrading Union Pacific to hold. The analysts anticipating export challenges due to tariffs. Shares pretty much unchanged, maybe a little bit higher, Danny.
Well, speaking of tariffs and trade, Katie, back to one of our top stories this morning, and it is around tech, with China urging local companies to avoid using Nvidia's H20 chips. Now, that guidance, it is not a ban, but a discouragement, particularly for government-related purposes. Joining us now is Bloomberg Tech co-host Caroline Hyde. And Caroline, it seems the information adding to some reporting here, but what do we understand about the current state of China and allowing their companies to order these chips?
Well, exactly the risk that Jensen Huang, the CEO of Nvidia, has been trying to tell the market time and time again, trying to tell the government time and time again. If you limit our ability to sell our high-performance chips into China, and indeed if you curtail the performance of the chips, of course they've asked them again and again to make them less and less useful and powerful, so that's why you've got the H20, which Trump himself calls obsolete. If you do that, you will spark innovation in China and they will outcompete us. They will start to lean in on Huawei's Ascend Accelerator program. You will start to see the ByteDances and some of the other key giants, the Tencents, the Alibabas, go to local domestic production rather than Nvidia and AMD. And here we have it. We are reporting that already we look like the government is leaning on these big tech giants to try and perhaps pull back from their dependency, particularly around government-related use cases. But the information is also going a step further, saying it's not just leaning and saying and nudging, it's actually demanding that these big tech giants don't buy the H20. This is, of course, exactly what had been perhaps thought through by some of the leaders in chip makers here in the US.
Well, you touch on what I've been wondering about, because we've been talking about the US government's perspective, we've been talking about China's perspective, but this must be enormously frustrating for CEO Jensen Huang. I mean, you think just about the money that he's losing by not having access to the Chinese market, but then that existential fear that you bring up that maybe they're going to get left behind, that you're going to see some of their Chinese competitors really step up their game.
And look, this is the paradox, and probably one that the US government, of course, had thought through. If we keep making these CEOs, Lisa Su and Jensen Huang, play a game of ping pong instead of focusing in on innovation and in sales, when probably you're going to spark an issue here. And of course, that's exactly what's happened. They are losing a ton of money. Now, we understand, of course, we estimate, Bloomberg estimates about $7 billion worth of H20 chips go from Nvidia per quarter to China. And of course, that's a nice little earner if you're able to make 15% cut on that. But in so doing, you're hearing that the Chinese pushback is there, that they don't want $7 billion worth. And in fact, they want every company to be trying to avoid these sorts of business deals with US giants. They don't want it in their overall tech stack. And also, there have been some fears they've been articulating. They worry about security, efficiency. And meanwhile, all of this has been going on. Huawei has been busy trying to innovate, getting money from the Chinese government, a special tech fund. There is a lot of concentration going on China to try and outcompete. And here lies the paradox. Yes, you try and curtail, you're going to have an issue.
One of the interesting things, though, is Jensen Huang had made a concerted effort to appeal to the Chinese. On Trump's inauguration, he wasn't at the White House, he was in China. So we see this effort from tech CEOs to try to play politics.
Yeah.
Caroline, we have to talk about what happened with Lip Bhutan of the Intel CEO yesterday. It seems that Trump has had a bit of a 180 after meeting with the Intel executive.
And that's always what everyone prepares themselves with President Trump. And indeed, Lip Bhutan has done what was necessary in terms of actually deciding to go to the White House, and what he declared would be trying to restate misinformation in the market about his relationship with Cadence, where he used to be the CEO, and what had been done with Chinese institutions, and indeed how some of his own investments that he's made with his venture firm into Chinese stars in the chip sector. SMIC, he was actually on the board of that company. All of this was known, but it suddenly sparked worry amongst lawmakers, and again from the administration itself, where they called for his own ouster, for him to remove himself. He's managed to persuade President Trump, with some warm tones coming from President Trump, saying what a success story he's had as someone who has come as an immigrant from Malaysia, built himself as a US citizen, and managed to become the CEO of an incredibly integral company. Now he has to go back next week, talk with cabinet members, we understand, for President Trump. What then of the innovation that's going to happen here in the United States thanks to Intel? What then of manufacturing? What then of some of the access to $8.5 billion of the CHIPS Act money?
Looking forward to see how those conversations shape up. Of course, Intel, an American icon, but definitely feels like it's been on the decline. That is Bloomberg Tech co-host Caroline Hyde. Now, we do have some breaking news. That is President Trump saying that he is considering suing Fed Chair Jerome Powell over his handling of reconstruction of the Federal Reserve's buildings. Michael McKee, he is Bloomberg's international economics and policy correspondent. He joins us now. Specifically, Mike, he says that he is considering allowing a major lawsuit against Powell to proceed because of the horrible and grossly incompetent job he has done in managing the construction of those buildings. What do we know so far?
We don't know anything. This seems to be another effort by the president to flood the zone, as they say, just come up with all kinds of distractions to keep people not thinking about some of the other things they don't like about his administration. There wouldn't seem to be any way to sue Jay Powell for this. First of all, you'd have to have somebody who could have standing. In other words, somebody who could claim they were harmed by whatever the Fed chairman did or did not do. And then it would have to be proven that Jay Powell did something wrong. The fact that a building is over budget, I think any of us who have had home repairs done know about things going over budget when you're doing construction. So I don't think there's really going to be any lawsuit. Remember that his whole MO is I'm threatened to sue or sue people, and he loses almost all those cases, but settles them or something. It's just what he does to try to intimidate people. I find this tweet interesting, though, because not only is he insulting Jay Powell by going back to the too late thing, he's now insulting Steve Mnuchin, his Treasury Secretary, in his first term, calling him Maniuchin, something like that. I don't know how he pronounces it, and I don't know what that's supposed to mean.
I think that might be an attempt at a phonetic spelling at Mnuchin. That is literally my only guess. But to your point, Mike, he's criticizing his former Treasury Secretary for picking Powell. It seems like his current Treasury Secretary right now is leading the search for who will replace Powell. How is that search shaping up? And I mean, you got to look at this, Mike, and say, is he maybe taking a second thought about letting someone else lead the search for who becomes the next Fed chair?
No, I think this is very typical Trump. It's not my fault. I didn't have anything to do with this Fed chair. It's Steve Mnuchin's fault. Now, the interesting thing is 2 years from now, whoever is Fed chair, we'll see if he likes that Fed chair or if he blames Scott Bessent. And what nickname will he give Scott Bessent?
I think it's Scotty B, right?
Well, now because he likes it.
Right. If it turns negative, Scotty F,
if it
maybe.
turns negative.
I don't know.
I mean, the bottom line is he says Powell needs to lower the rate now. Obviously, the Fed chair can't lower the rate by himself, and there's no Fed meeting until September 17th. So it's in that sense, it's kind of meaningless.
Fair enough. All right, Mike, thanks for keeping us up to date on that. That is Bloomberg's Michael McKee. For what it's worth, 30-year yields at highs of the session up just over 3 basis points. You are watching Bloomberg Open Interest.
Welcome back to Open Interest. Let's take a check at this market right now. The S&P 500 still higher, but gains actually coming in a little bit after we heard from President Trump that he's considering allowing a major lawsuit against Fed Chair Jerome Powell. The Nasdaq 100 also coming in up about 0.3%. It's still the Russell 2000 that is leading the way. We'll have to see how that develops. Let's take a look at some of the individual gainers right now. You do have some good news in the form of Meta. You have Circle higher as well. They reported earnings. Those were well received. Nvidia has been sort of treading water here. It's now a little bit lower. Of course, it is firmly in the crosshairs of U.S. and China trade negotiations. Hims & Hers Health down about 4%, and then Celanese Corp down 21%, Danny.
Some other movers that we are watching this morning, Katie, worth pointing out pot stocks, if we can get a look at those, because why not? Trump saying yesterday that he might consider reclassifying marijuana, putting it at a lower schedule. You can see Tilray there up 13%. This market acting like the federal government's going to legalize it should, again, just worth note, it will still be illegal. It will just be at a lower classification of illegal.
Just like a little bit less illegal. What
right.
I find interesting is that, I mean, people have been getting behind pot stocks for a while now. There's been a lot of false dawns here when it comes to how they'll be treated legally. But if you take a look at where the money is going, ETF that I like to watch, ticker MSOS, this is the Advisor Shares Pure U.S. Cannabis ETF, not really seeing a ton of inflows. It took in almost $20 million yesterday, but in ETF land, that's pretty much a drop in the bucket. So investors, still a lot of skepticism here, I think it's safe to say.
Does that just speak to who's investing in these pot stocks? If the individuals are going up, is that basically just like the online Wall Street bets are betting and maybe more measured ETF people aren't?
I don't think a lot of institutions are putting big money into the marijuana.
You're probably right. I don't think they're allowed to, a lot of them.
But if you are, let us know. In any case, coming up in the next hour, great lineup. Rebecca Patterson joins us to talk CPI and U.S.-China trade relations. Then Marsh McLennan CEO John Doyle joins as well, and Claudia Sahm. This is Open Interest. All right, we are 30 minutes into the trading day, a trading day that started out a little bit stronger than where we sit right now, Danny. The S&P 500 up about 0.3%. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Danny Berger. Sure, stocks are holding on to gains, but you are looking at the bond market increasingly losing some of those. You just saw the front end. It is a long end at the moment that's moving higher as well.
Yeah, very interesting. A lot to get into, including that market reaction.
Well, coming up, we're going to talk about that inline inflation bolstering speculation that the Fed will be able to cut rates next month.
90 more days. President Trump extends a trade truce with China into early November.
But Beijing's new guidance on Nvidia chips may stir up tensions once again.
But we begin with CPI, underlying inflation accelerating in July to the strongest pace since the start of this year. Michael McKee, he is Bloomberg's international economics and policy correspondent. He has the details. And it's interesting, we just got a note from Neil Dutta over at Renaissance Macro saying that if I take the data at face value, it implies that tariffs are not being passed on to consumers, which means firms are tolerating a profit margin squeeze for the time being. When you take a look at the details of this report, is that your read as well?
It's only a partial read for me, because there are some areas in which companies seem to be absorbing it, and there are some areas where they seem to be passing it along. Headline comes in at just 0.2 of a rise. A lot of that was because gasoline prices, pushed down by seasonals, were down by 2.2%, but CPI core comes in a little hotter, 0.3%, and pushes the year over year up to 3.1%. The Fed will be looking at that. I'm not sure they're going to panic over it, but they will be looking at it. And when you look at what moved a lot, airline fares were up 4%, nothing to do really with tariffs. And then you look at something like tomatoes up 3.3%. We tariffed Mexican tomatoes. We tariffed coffee, and coffee, as I mentioned, was up 2.3%. Appliances were down. They were up in the prior month. Household furnishings, though, up 0.7. So you look at something like new cars. We saw earnings reports from the car makers saying that, they had poor earnings or worse than expected earnings, and they're absorbing it. But the household furnishings people are not absorbing it. The grocery stores are not absorbing the tomatoes. So it's a mixed bag over whether companies are absorbing it or not. And in some cases, the car makers have suggested, for example, that they are just waiting for the 2026 models to come out, and then they will raise prices. Companies want to take this slowly. They don't want to hit people all at once. We've had announcements from other companies, Procter & Gamble, Kenvue, others, that they're going to be raising prices on consumer goods. So
you want to make people upset, Mike, you either have expensive eggs or expensive coffee. So probably not a good sign you got expensive.
Well, the good thing for the president is eggs were down.
There you go.
3.9%, but coffee prices were up. So
our quarterly egg checkup with Mike McKee. Mike, thank you so much, or monthly, I should say. Bloomberg's Michael McKee. Joining us around the desk now is Council on Foreign Relations Senior Fellow and former Bridgewater Chief Investment Strategist, Rebecca Patterson. Rebecca, wonderful to see you this morning.
Great to be here.
To the point of Neil Dutta that Katie was mentioning, Goldman Sachs also had a study that 2/3 of companies have absorbed tariffs so far in corporate margins. Is it your expectation that at some point that will end and potentially result in weaker growth as consumers push back against higher prices?
I think it's going to be very company dependent. If the companies have the wiggle room in their margins to absorb, and if they have a price sensitive customer, they'll probably absorb. But I think we are seeing more and more companies, as Mike mentioned, Nike, Procter & Gamble, saying we have to raise prices. And some, like tomatoes and coffee, which kills me, are already going up. But like he mentioned, Ford as well, they're estimating they're going to have a $2 billion hit from tariffs this year. So it comes one way or the other. It's either going to be corporate margins, which all else equal is a drag on the stock market, or it's going to be in the consumer, which is a drag on the economy, which then feeds through to the stock market.
At least we do have egg prices coming down. Maybe that nets out with coffee to make your breakfast.
It's a big enough component, eggs.
There you go. I do want to talk about the fact of why we aren't seeing every company in every industry pass along those costs. I assume it's not out of the goodness of their hearts. I assume it's because you have kind of an exhausted consumer. We're talking about the pace of inflation slowing down, but after many years of these sorts of increases, we're at a very high overall level.
Yeah, I mean, Friday we have retail sales, so that'll be an interesting check on where the consumer stands right now. We did have inventories built up before the tariffs took effect, and so they could use those inventories at lower prices. That's pushed back the hit to consumers from this. and I don't know this, but I would imagine within some companies there's an element of, if I raise prices and it gets reported in the media, I might be in the president's crosshairs. So that might be one reason that some are also reluctant to do too much too quickly.
It is such a good point, and perhaps part of the reason why this earnings season, you haven't really seen companies guide that way. But Rebecca, they've also been punished a lot if they do guide that way, or even if they miss a little bit. What do you just make of the volatility and reaction we've gotten to companies that have given negative or missed this earnings season?
I mean, the bar was so low for this earnings season that if you missed a low bar, something's really wrong. So if you beat the bar, you got rewarded for that, but not by huge amounts. You couldn't miss the bar. And one thing I'll just add, tangential but interesting, I'm seeing more and more companies knowing that analysts are using AI to scan their earnings and figure out how to trade it immediately. So the companies are now using AI to prepare their guidance to try to maximize the response by the analyst community. So we're in, it's a total separate thing from our conversation right now, but it is so cool to me that this is going on.
It's like
I just
a step
want
closer, though, to just like AI giving earnings and AI reacting to earnings and just cutting out humans.
Just the robots talking back and forth to each other.
So a bit of an aside, but for people following AI out there, you can just put that in your notes to look at.
Yeah, definitely. Well, speaking of earnings calls, we had a great story on the Bloomberg terminal this morning about CEOs hardly talking about a recession this reporting season. Some interesting stats here. You have executives for companies listed in the S&P 500. They've so far mentioned a recession fewer than 300 times during second quarter earnings. That is the lowest going back to 2001. So at least we have one potential big uncertainty put to bed.
Again, I don't want to second guess why they're saying what they're saying, but if you run a big company and you know your share price is going to be affected by what you say and how you say it, why do you need to mention a recession in your earnings? You could say we have uncertainty or we see some downside risk. I will say the Conference Board quarterly CEO survey that just came out about a week ago showed 34% of CEOs planning to lay off workers in the next 12 months. That was the highest percentage since 2020. So they might not be seeing a recession, but they are planning on reducing their workforces because they have higher input costs, partly because of tariffs, because there is business uncertainty and a possibility of a recession. So they're starting to clamp down, and that's going to feed back through the consumer. If there are fewer jobs, there's less income to spend. So this all creates a feedback loop. And I think the more dovish members of the Fed, they're more focused on that. And then the hawks are saying, yeah, but wait a second, inflation's at 3.1.
How do you then balance a Fed that is going to cut and the one big beautiful bill starting early 2026, giving that additional fiscal boost versus some of the weakness that you're noting?
Yeah, I think David Kelly over at JP Morgan's done a nice job analyzing this, and there will be some really nice tax refunds coming in the spring of 2026 and some other goodies. The question is, what environment is that coming into? So maybe people get a tax refund, but if layoffs are continuing the way I just described, they might not be spending all that money unless they have to, right? Necessities rather than like to haves. So I agree, all else equal, it's a fiscal boost. The question is how much will be spent versus saved, and that'll depend on where we are next spring. And right, like this is not the easiest moment to be forecasting that, given that the tariff rates, the tariff timing changes by the day.
Yeah, sometimes by the hour. Rebecca, you're sticking with us. We're going to talk a little bit more directly about trade talks next. That is Rebecca Patterson. Let's get a quick check on some single stocks moving at this hour. We'll do that with Bloomberg Equities reporter Alex Semenova.
Hey, Katie. Shares of Intel are climbing this morning after President Donald Trump called his meeting with the CEO a very interesting one. This comes just days after he called for the chief executive to resign. He now says that he and his cabinet members are open to continuing discussions with the company. Trump posted on social media saying that his success and rise is an amazing story. Intel said in a statement that they discussed the company's commitment to strengthening U.S. technology and manufacturing leadership. The chipmaker shares are up about 2% right now. They had fallen 3% on August 7th upon the initial remarks. We're also taking a look at pot stocks. Those are climbing into second day after President Donald Trump said that he would reclassify the substance Stocks like Village Farms International, Tilray Brands, and Canopy Growth are all climbing after posting double-digit gains yesterday. Trump told reporters he was looking to make the change over the next few weeks. And finally, On Holding lifted its sales and earnings forecast. The footwear company expects growth of at least 31% on a constant currency basis in this fiscal year. Guys.
Alex, thank you very much for those details. Bloomberg's Alex Semenova with On shares rallying this morning. Coming up later this hour, former Fed economist Claudia Sahm on the state of the labor market and the new head of the BLS, plus a flavor of Trump tweets saying that he would move to sue Jay Powell or at least support it. All of that coming up on Bloomberg Open Interest. Stay with us. Now to high interest, a look at what's making headlines around the world. First up, Elon Musk accused Apple of favoring OpenAI, saying the company makes it impossible for anybody else to reach the top charts of the App Store. Musk said that Apple's behavior is a, quote, antitrust violation and that XAI will take immediate legal action. Elsewhere, President Trump said his meeting with Intel CEO Lip-Bu Tan at the White House yesterday was, quote, very interesting. He also called Tan's success and rise an amazing story, adding that Tan will meet with members of his cabinet in the coming days. Those shares up 2 1/3%. Elsewhere, Nvidia to the downside this morning. China is telling local companies to avoid using Nvidia's H20 chips. Sources telling us here at Bloomberg that guidance over the past few weeks has been particularly strong against use of the chips for government-related work. And Katie, the information adding to that reporting saying that they are outright telling companies do not take Nvidia's chips.
Well, Danny, let's keep that conversation going because we're back now with Counsel on Foreign Relations Senior Fellow and former Bridgewater Chief Investment Strategist Rebecca Patterson. So, Rebecca, you rewind to yesterday to the news that Nvidia and AMD agreed to pay the U.S. government 15% of the revenue from some chip sales to China. Definitely caught a lot of people by surprise, unusual, unprecedented. Just some of the words used to describe this arrangement. How would you describe it?
Possibly illegal, and a little confusing, frankly, because if our main national security concern is AI and China, then we shouldn't be sending them any chips, although there's an argument that if we don't, they'll build their own. I think that's debatable. But then if our biggest worry is helping the U.S. with AI, why would we slow down Nvidia and AMD by charging them anything? If we want to let innovation thrive, we should be supporting them, not putting a tax on what they sell. So it's hard for me to add up exactly what the thought process was on this one. So I agree with you. Unprecedented. I forget your second word. Unusual. Yes, all of these things.
Well, how about this for another descriptor? And this is what the Wall Street Journal wrote yesterday, Greg, over there, saying the U.S. marches towards state capitalism with American characteristics, saying that we are almost mimicking some of the moves done by the Chinese Communist Party. Would you also agree with that characterization?
I mean, the Communist Party comment is obviously a bit provocative, but I think directionally, look, the stock market's near all-time high. It's being led by tech companies. No one wants to get out of a position when quickly, we don't know when, we could have superintelligence, and there could be a lot of returns that come on the back of that. At the same time, you know, businesses need certainty, right? Whether you're a tech company or any company. And when you have a president and a cabinet who seem to be making policy changes somewhat arbitrarily and very company specific, it's not capitalism, it's not laissez-faire, it's not a deregulatory government, it's a picking winners versus losers. And that's not giving certainty. And I think we do see that reflected in company surveys. Just this morning, the Small Business Confidence Survey, it went up in July on the back of the big, beautiful bill passing, but the uncertainty index also went up. And I think that's part and parcel of all the policy changes that we're seeing that are hard to predict. You want predictability. You want low vol in terms of policy, and we're the opposite of that right now. So I agree with Greg on that front. You shouldn't have winners versus losers. You should have certainty.
Yeah, well, that was a really interesting readout, the fact that, okay, maybe we feel a little bit better, those small businesses, but we're also still really uncertain. Just, again, when it comes to this specific situation with NVIDIA and AMD and the U.S. government, it does call into question what the Trump administration is trying to accomplish in this relationship. When you think about export controls on chips, originally it was about national security concerns, but this seems to be more about raising revenue.
Yes, and we do need revenue. And there's a question if the reciprocal tariffs, the Emergency Economic Powers Act tariffs, the IEEPA tariffs, are ruled illegal, which is probably not going to happen, but it could. In theory, the government has to repay all these companies. That revenue goes away. So the revenue question is a real one and something people should be thinking about. I think with China in particular, look, they want China to rebalance its economy more towards domestic consumption. That would help the trade deficit. They want to deal with forced tech transfer. They want them to buy more goods like U.S. soybeans. But there's also stories that are less discussed. They don't want much higher tariffs on China ahead of the holiday shopping season here in the United States. That's a good reason to postpone till November. And they don't want retaliation. We can't survive without Chinese rare earths. The U.S. imports 70% of its rare earths from China. There is no near-term supply substitute. We use them in everything from smartphones and TVs to missiles and submarines. So we can't afford to have China take that step towards us. And I think they know they have leverage. That's another reason I believe that we have paused this for another 90 days.
Hey, Rebecca, if I can just add another corporate executive to those being targeted by Trump, just to take a pause here, because we got a Truth Social from Donald Trump just now talking about CPI, talking about inflation, saying that tariffs aren't causing inflation, going on to say that David Solomon and Goldman Sachs refuse to give credit where credit is due. They made a bad prediction a long time ago. They are wrong about so much else. I think that David should go out and get himself a new economist, or maybe he ought to just focus on being a DJ and not bother running a major financial institution. Rebecca, I can only imagine that this refers to Jan Hatzius yesterday saying that U.S. consumers will bear the brunt of the tariff costs. So here you have, again, another CEO targeted by Trump. When you look at something like this, we've been talking about the strength of financials, the fact that regulation is going to come support them. Do we have to look differently at deregulation and the federal government aiding them hand? If Donald Trump, he was also going after J.P. Morgan and Brian Moynihan not that long ago, too. Does this change maybe the enthusiasm over that sector?
I mean, I don't think so, because I think it's pretty clear that this administration wants to reduce regulation on the financial sector. I mean, President Trump's family is supporting the financial sector personally. So I think this is more just one-off hits, venting maybe even. But no, I think, look, the financial sector is benefiting from the volatility. We saw the revenue from the trading desks. They're benefiting to date from a consumer that's still in decent shape. We'll see how that evolves going forward, though. And they've been benefiting, especially recently, from a little bit of a pickup finally in M&A. And deregulation can help them further. I don't think it's going to be a magic bullet, though. You know, there's this hope that if change regulations around capital requirements, for example, that suddenly banks will buy tons more treasuries and that'll keep the 10-year yield low and help the housing market. I think that's wishful thinking. So the deregulation, all else equal, is going to be helpful for that sector. I think a lot of that's probably in the price. And going forward, again, I don't think there are magic bullets with this. But yeah, I think the sniping and the Truth Social posts are more venting frustration than necessarily going after a certain bank. But look, I can't read the gentleman's mind. I'm not going to try.
Well, going back to that Jan Hatzius note that got him in hot water, it's really interesting, actually. It's what we were just talking about with Mike McKee. He says that, and him and his team, that is, consumers in the U.S. have absorbed an estimated 22% of tariff costs through June. American businesses have absorbed around 64% of those costs so far, but their share will fall to less than 10%, thus passing the burden on to consumers. So he's going after CEOs across industries. He's also going after Jerome Powell very hard just this morning on Truth Social, threatening to allow a major lawsuit against the Fed chair. I mean, in your estimation, we haven't seen this really spook the market in a big way so far. Do you think that changes?
I mean, if they actually try to fire Jerome Powell for cause and really move that forward, that could spook the market, certainly, because that would be a new, crossing a new red line. But look, the jobs market was soft enough that I think if the Fed wants to take out an insurance cut at its September meeting, it could justify that, and it has plenty of data to do so despite this inflation print. We saw the same thing happen in 1995. Inflation was running above target, the job market was okay, and they cut 75 basis points over about a year and a half period. Stock market loved it, went up, and it led the economy to stay strong for a couple more years, and then we hit a crisis. It's possible we see that movie play out again. I think the difference this time, though, is that inflation is significantly higher, right? 3.1 on core CPI is almost a whole point above where we were in 1995, and the tariffs make that position even worse. Plus, the Fed just got through a mistake with the pandemic inflation, and that's going to be top of mind. So I think we will get a cut in September. I think the market's priced in so much that unless we got some really surprising data between now and September, that cut's coming. But to get 3 cuts or even 100 cuts by the end of, in the next 12 months or so, you'd have to have the labor market really tank for that to happen. And obviously none of us want to see that, nor does the Fed.
All right, Rebecca, you've been so generous with your time this morning. Wonderful to have you here to react in real time to some of the breaking news that we're getting. That is Rebecca Patterson. Now, still ahead, Eric Schatzker talks about his exclusive big take conversation with Treasury Secretary Scott Bessent. That's coming up later this hour. This is Open Interest. Welcome back to Open Interest. A check on these markets. The S&P 500 not quite at session highs, but bouncing back, leading the NASDAQ 100 right now because you now have Nvidia down about 1%, acting like a weight on that benchmark. The 10-year Treasury yield down about 3 basis points. That rally continues. Don't go anywhere. Much more markets coverage coming up. This is Bloomberg. Well, CEOs listed many worries on second quarter earnings calls, but recession, not one of them. Executives mentioned an economic contraction less than 300 times during those recent calls. Now, that compares to over 800 times during first quarter reports. Let's discuss the state of sentiment with John Doyle. He is CEO of Marsh McLennan. He says that global economic outlook remains uncertain. John, great to have you here in person. Let's talk a little bit about what the mood music is like. We do know that just the outright mentions of recessions are going down, but what are some of the big issues that are really keeping CEOs up at night?
Well, good morning. It's great to be with you. Yeah, we spend a lot of time and have the privilege of advising businesses all over the world, trying to navigate the current environment. And, the complexity of the moment is really what stands out. And so, whether it's ground wars, trade wars, culture wars, the promise and risks around AI and emerging technologies, extreme weather events, creating chaos for humans and humankind around the world, but also for supply chains and for economies. And so navigating that complexity is the challenge of the moment, and trying to grow their business through that is their focus. And what I would say in our dialogues with clients all over the world, they're a bit more focused on the short term in navigating some of this uncertainty, while at the same time sorting out how AI might impact their business or their industry.
Can I just add another headwind to that?
Sure.
Because there is this trend that seems to be evolving since the start of Trump's presidency, and that is calling out specific CEOs. It was Walmart at the start of the year. It was Intel last week. Today, it is Goldman Sachs' David Solomon. How would you advise a company to deal with something as complex as a president specifically singling out a CEO for something he doesn't like?
Well, it's clear the playbook in Washington has changed, right? And so we all recognize that, and we're all trying to navigate how those changes have manifested themselves over the course of the year. There's a lot of good things that are happening in balancing trade and opportunities for American-based businesses all over the world, and so as a community, we're embracing those kinds of things, but also trying to really understand the priorities of the administration and how our businesses may run into some of these issues. So it's not head down. Our roles are to represent our companies and our businesses and the markets that we're trying to serve. And so, heads up and communicate effectively.
Well, something that I don't think I heard you mention, and forgive me if you did, when it comes to that worry list of concerns, what about cybersecurity? It feels like that is an ever-present, evergreen sort of issue that's floating out there.
Well, I didn't mention it specifically, but it's part of the perils around AI and the rapid development of large language models. And so, when our biggest business inside of Marsh McLennan is our risk businesses. And welcome relief for our clients, and prices have actually been moderating over the course of the year, which is terrific for our clients. However, the cost of risk continues to escalate, and cyber is a great example of that. And so planning for and really doing a lot of scenario planning around certain cyber events and more extreme cyber events as a result of AI-generated risks is an important part of how we're advising clients today.
With the list of risks, there's an expectation that we're likely to get an active wildfire season coming up. Already it follows the start of the year, the devastation that we saw in Southern California. Just how different is the market and the insurance market following that?
Well, as I mentioned, prices have begun to moderate during the course of this year. That's after several years, though, of price increases. And so the insurance market is pricing in a much higher level of catastrophe risk. Wind, flood, fire, quake, so much higher pricing is built in. And so we got off to from an economic standpoint, obviously human tragedy in what happened in Southern California. But from an economic perspective, we got off to a tough start with the wildfires in Southern California. Right now, there are wildfires raging in more remote parts of California, in Canada. There's news this morning from Europe, in Turkey, for example, the Dardanelles, facing shutdown through the Dardanelles. And so it's another area that drives supply chain risk. But also, we need to build back in a more resilient way, right? And so insurance and the insurance industry and risk financing will be there. But we have a lot of data and information about how to build more resilient communities and more resilient economies. $40 to $50 billion of insured loss in Southern California, but $150 billion economic hit, when I'm sure the governor in California would rather be investing in other ways.
Yeah, absolutely. Well, in addition to, of course, wildfires and these weather events, you also mentioned on your earnings call that pushing up the price of insurance, your insurance costs, are nuclear verdicts. And I was hoping you could give us a little bit more information about what that means and what effect that's having.
So nuclear verdicts, in our industry, we're in the business of helping clients think through some of those more severe scenarios. $100 million judgments or more, up 400% over the course of the last decade. So you have a very powerful plaintiffs bar in the United States. You have increased litigation funding as an asset class in the United States, fueling what is a growing cost of risk around liability insurance. The United States, by far today, already has the highest cost of liability insurance of any market around the world. And I'm very, very worried about it. I mentioned that prices are coming down. Liability insurance prices are continuing to escalate. And so there was an opportunity in the One Big Beautiful Bill to straighten out some tax incentives around litigation funding. Unfortunately, that didn't happen. And so as an industry, we were quite vocal about that opportunity. Lit funding is just one aspect of it. There's tort reform that needs to happen at the state level. It's happened in Georgia. It's happened a bit in the state of Florida as well. And so as an industry, we're helping our clients think through how to manage that rising cost of risk.
John, if we can just end around where we started, this idea of navigating a lot of headwinds. To what degree are you seeing companies still frozen and putting off investment decisions because of that, or moving forward now?
We're starting to see a bit more clarity, right? And I think some of the bigger downside scenarios around the trade discussions all over the world have begun to come in, right? And so we're starting to see M&A activity pick up, for example, but also businesses need to make decisions. You need to move forward. And so obviously there's still more clarity in front of us and how it impacts the economy and ultimately settling many of these trade negotiations around the world. But we're starting to see some level of clarity, and that's helpful, obviously, to the economy.
John, thank you so much for joining us this morning. That is John Doyle of Marsh McLennan. A lot of interesting things for companies to try to navigate. For this market, it is a CPI that came in line, and that was good enough to get an equity market rally. We're up by 0.5%, but it is notable, though, that a 10-year yield is moving higher now, up 1.5 basis points, even more for the long end. Perhaps it's a concern about stickier services inflation, or a president that has tweeted that he would recommend a suit of Jerome Powell. Let's look underneath the surface, though, look at some of the single stocks moving this hour with Bloomberg Equities reporter Alex Semenova. Hey, Alex.
Hey, Danny. Citi CEO Jane Fraser is in Mexico City for talks with President Claudia Sheinbaum. Among those discussion items are the potential listing of Banamex Citi's retail unit. This is according to people familiar with the conversations. The meeting comes as Citi prepares to launch an IPO for Banamex, and Mexico remains remains in talks with the U.S. to avoid higher tariffs on exports to the country. Fraser and Sheinbaum have met a few times over the past year. Citigroup has been courting wealthy Mexicans to buy a chunk of Banamex that could be built into a controlling state. And in other corporate news, the FDA is considering revoking Pfizer's authorization of its COVID vaccine for children under the age of 5. The agency told Pfizer it might not renew the pandemic-era authorization covering the youngest children. Pfizer has requested the authorization stay in place through the coming fall season, and it's currently in discussions with the agency on potential paths forward. The stock is down about 0.2% right now. Moderna's competing vaccine is approved only for children under 12 who are at increased risk of the disease due to underlying conditions. And finally, shares of Sinclair are rising right now this morning after the company launched a strategic review of its broadcast unit and also is considering a separation of its ventures unit. It is evaluating all value-enhancing opportunities, including acquisitions, strategic partnerships, and business combinations. The company's broadcast ad revenue rose last quarter. The ventures arm includes assets in real estate, private equity, and tech. The TV station owner did say that there is no guarantee a transaction will take place. Shares are up about 14% right now, guys.
All right, great roundup, Alex. Appreciate that. That is Bloomberg's Alex Semenova. And coming up on Open Interest, Claudia Sahm of New Century Advisors joins us as investors boost their Fed rate cut bets. We'll discuss next. This is Bloomberg.
U.S. consumer prices rose roughly in line with estimates in July. That has been boosting the expectation for a Fed rate cut in September. Joining us now, Claudia Sahm, a former Fed economist, now chief economist at New Century Advisors and a Bloomberg opinion columnist. Claudia, wonderful to see you this morning. And odds of a Fed cut that this market is pricing in is now more than 90%. Is September a done deal?
September is not a done deal. I mean, we don't have the data that puts this one in the bag yet. I think it's likely. I think we're better than 50% odds of seeing a rate cut in September. But remember, the Fed is likely, when they come into September, they'll have one more CPI, they'll have one more jobs report. In all likelihood, they would be thinking about doing a cut as inflation is rising, right? And the labor market, while we have seen some softening, we still have a relatively low unemployment rate. And I think for me, what was most disconcerting in today's CPI data was to see some firming in core services, particularly in the non-housing core services. And that's the piece that if the Fed gets comfortable with, quote unquote, looking through tariffs, one-time price adjustment, inflation is temporary, well, then they're going to turn their attention and look at the other parts of inflation, these core services. And frankly, we don't see the sustained progress back to target in those services. And that's going to make it really tricky for them to justify and want to go forward with a rate cut. So we're not there yet in terms of seeing rates come down.
Yeah, and it's interesting, this focus on services, because a lot of folks have been taking a look at goods specifically as just the cost of raw actual objects goes higher. But Claudia, you mentioned that we have another inflation report in the form of PCE. We have another jobs report before we get to that September Fed meeting. It feels like the Fed was feeling pretty comfortable when it came to the labor side of their mandate. And then we got the July jobs report. When you think about trying to navigate that dual mandate, which do you think is the bigger concern for policymakers at this stage?
But, they look at where the employment and inflation are relative to their mandate. And we know, and it is very important context coming into this, that inflation is elevated relative to target and has been for over 4 years, right? So inflation does start out in that place. And then there's this question of, well, when you get off target, how long does it take to get back to target? And that's another piece where, again, not seeing that services disinflation really picking up speed, that also is a mark against on the inflation side. And so then, they're looking at the labor market and they'll be balancing, the softness we've seen. Some of it's probably coming from a supply side, from less immigration. That's not something that the Fed would normally be reacting to. Again, the unemployment rate is still quite low. Wage growth has held up well. So, and then we get into this space that thankfully doesn't happen very often, where we have the two goals in conflict, and it is going to come down to a judgment call. like each official will have to weigh between those two, the two sides of the mandate. And that's not something, I mean, that's really going to be their decision. There's not a, textbook, this is the way you go forward with it. So, and that's why it could take the Fed a little bit more time to get comfortable with, we're ready to start reducing interest rates.
There's also this idea, Claudia, that at least as of this moment, firms have largely been absorbing any price increases. Goldman Sachs estimates that about 2/3 of firms so far have absorbed higher prices of tariffs in their corporate margins. But that could end. That could end if they don't want to continue to put up with margin compression. What happens if it does end? And is that something that, again, is a one-time adjustment and is something the Fed can look through?
Yeah, what the Fed is really concerned about are not the first round effects. I mean, I think there's an expectation that businesses will eventually pass this on to consumers. Maybe they do it more slowly to, try and protect, their market shares and what have you. The risk that the Fed is concerned about is there being a second round effect, some kind of feedback effect. The tariff induced inflation spills over into services. Like, they're looking for these risks. And I think the Fed can make a case that some of the risk factors have toned down. So we saw again with the 90-day trade extension with China, with keeping the tariffs at the 30%. The administration is trying to avoid the all-out disruptive trade war, the very high tariff rates. Those are the kind of things that risk turning into feedback effects, and a trade war could cause inflation to really spread out over time. So it's the risk of the tariffs turning into.
Oh, it looks like we've lost Claudia. Hopefully we can get her back.
Many Claudias there, actually.
Yeah, a whole universe of Claudias. Really interesting conversation, though, there with Claudia Sahm of New Century Advisors about really where inflation is, what the Fed is going to do about that dual mandate, especially when the two pillars of it come into conflict with each other.
Well, and again, it's this concern, which maybe is part of the reason the long end is higher, is the fact that services weren't coming down in a way that you think would offset some of that goods inflation. Of course, they could also be higher because Trump tweeting today about suing Jerome Powell. Certainly not helping.
That's true. We'll continue to discuss that. And coming up, we'll discuss Treasury Secretary Scott Bessent, his views on tariffs, deficits, and Trump's economic plan. That's our latest big take, and that discussion coming up next. This is Open Interest. Treasury Secretary Scott Bessent has emerged as a key player in U.S. trade negotiations. Our big take conversation with Bessent examines how the Treasury Department has really become a department of everything. And Bloomberg New Economy editorial director Eric Schatzker, who co-wrote that big take, he joins us now. I love that phrase, department of everything, because that's what it really feels like. That, yes, he came in as Treasury Secretary, but Scott Bessent's role has really expanded since January.
It tells you everything you need to know about how much confidence President Trump has in Scott Bessent as Treasury Secretary, because typically the Treasury Secretary would be involved in a whole host of things, including tax policy and Social Security payments and financial regulation and economic sanctions. But this Treasury Secretary has taken on a lead role as a trade negotiator, not just with the Chinese, but with the Japanese, with the Koreans, with the Indonesians. By way of example, he was also instrumental in shepherding the OBBBA, the One Big Beautiful Bill Act, through Congress when there was opposition both on the Senate side and the House side among Republicans. It was Scott Bessent who sat them down and worked out compromises that ultimately got that bill passed before Trump's self-imposed July 4th deadline. And furthermore, at least for the time being, he's the acting IRS commissioner. Yeah. The man has a ton on his plate and yet continues to do an unbelievable amount of media, as we've seen. He has a ferocious work ethic and appetite, and seems to be able to get an extraordinary amount done in the space of every single day he's at the Treasury Department.
Like the president, I have no idea when these men have time to sleep. But it's not just Trump that has confidence in Bessent. It is a market, it is trading partners that like to see when Bessent is leading things up, or when Bessent is leading the search for the new Fed chair. To what degree is the Treasury Department also the Department of de-escalation?
Well, we call him the de-escalationist in a trigger-happy administration. because that really is the role that the market sees him playing. However, it's really important to point out that Bessent himself takes issue with this idea that he is a moderating influence over the president. In fact, he says it's never the market that pushes Trump, to pull back. In other words, Trump always chickens out Taco. That's just not true. The president, again, in Bessent's words, has a higher risk tolerance than he does. And so he's willing to allow things to run further to see where things go. This was exactly the case on Liberation Day. And it's a key part of the Bessent story we spent a lot of time on in this profile because, as you'll recall, markets globally were freaking out after that display of the placards in the Rose Garden, tariffs as high as 49%. We had the biggest two-day sell-off in stocks, not just here in the United States, but around the world since the pandemic. And Trump let that run for an entire week before pulling back. And it was Bessent, as he told us, on a flight with Trump back from Mar-a-Lago over the weekend in between, where he tried to persuade the president that it was time to pull back. And Trump said, no, let's let it run for a little while. It's a really fascinating insight into the way, not just the way the president's mind works, but the relationship that the Treasury Secretary has with him.
Well, speaking of the relationship, I mean, we got a post on Truth Social from President Donald Trump earlier today, writing about Jerome Powell. Jerome Too Late Powell must now lower the rate. But the next line, Steve Mnuchin, he spelled it in such a way, I'm not quite sure what he's trying to accomplish there. But in any case, Steve Mnuchin really gave me a beauty when he pushed this loser. So really taking aim at his former Treasury Secretary. It seems like this relationship, yes, it's very strong right now. To your point, clearly the president has a lot of confidence in Scott Bessent, but he's also very mercurial.
Sure, impetuous, mercurial. We can come up with a whole host of adjectives to describe who this president is and what he's like to work for as a boss. But Steve Mnuchin is a perfect example of somebody who figured out how to work for President Trump, and he lasted, unlike so many people in the White House, he lasted all 4 years as Treasury Secretary. And he explains it so well in this piece. He told me, you need to know who you're working for, right? You're not just working, in this case, you're working for President Trump, but you are working for the president. If you cannot represent the president well, the role, i.e. the role of Treasury Secretary, quote unquote, has no power. So don't go into this cabinet or this administration with your own ideas about how you want to do things. There is a commander-in-chief, decider-in-chief, if you like, and you need to get used to that idea and, if necessary, make your own compromises on a personal level in order to be able to represent the president and the administration well and to actually accomplish something in the role. Scott Bessent told us that even before being confirmed, he was drawing up a list in his mind of the things that he wants to accomplish while he's in office at the Treasury Secretary. And it's a list that runs to like 35 or even longer goals. Number one on the list is maintaining dollar supremacy, this idea that we don't, if you're in the administration, don't want to lose the dollar's role as the world's reserve currency. And it goes on from there. All
right. Well, it's a great piece. Really appreciate you coming on to talk about it. That is Bloomberg New Economy editorial director Eric Schatzker. And you can read the big take on Bessent online and in the September issue of Bloomberg Businessweek. Now, coming up tomorrow, we'll speak with Alicia Levine, Gabriela Santos, and the CEO of Potbelly. We'll see you tomorrow. This is Open Interest.